Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stock slip as strong US business data spurs bets on the Fed holding interest rates until at least December. Crypto win. The SEC approves trade products tied to Ether, opening the door for a spot ETF. And we are live at the G7 finance meeting in Italy, where Ukraine's allies are wrestling over a deal to use frozen Russian assets to support Kyiv. We are going to be speaking to the OECD Secretary General, Mathias, later this hour. Let's check in on these markets then. And as things stand, global stocks and bonds set for weekly declines. Yes, the good news on the data front, bad news for these markets theme is back with that US activity data. The composite PMI, services and manufacturing strengthening the most composite in about 2 years, and that led to a sell-off on Wall Street yesterday. Yields up. Across the European futures, you're looking at losses then of 0.5%. The FTSE 100 looking to drop around 74 points, down 0.9%. By the way, consumer confidence picking up here for a second consecutive month in the UK as well. Despite that, you're looking losses across the FTSE 100. S&P futures looking to modest gains of 0.1% after the losses of yesterday. Nasdaq futures looking to add 0.1%. And Nvidia, of course, was the bright spot yesterday across the US equity space with gains of around 9%. Let's flip the board and have a look cross-asset then. You did see a little bit of a sell-off coming through, particularly at the front end. Yields up on the 2-year at 492. You're not far from that 5% level right now at the front end of the US curve as markets price the first cut now in December, fully priced versus November, just 1 day ago. The pound in focus then on the back of that consumer confidence story, 126 on the pound, just shy of 127, and Ether in focus. We'll unpack this story in more detail in the next couple of minutes, but at 3,803 on the back of moves from the SEC, getting closer, it seems, to approving those spot ETFs, and Brent trading at $81 a barrel, currently flat on oil. Let's cross over to Singapore, where Avril Hong is standing by with a deep dive on the Asian markets this Friday. Avril.
Yeah, Tom, we're seeing a lot of risk aversion. It's those dialed back expectations of Fed rate cuts that are hitting Asia's equities and currencies as well. The gauge of stocks in the region headed for its first weekly decline in 5 weeks. The Korean won among those getting really hit the hardest today. And the Hang Seng is leading declines. The Nikkei not doing that much better and not helping sentiment along those China-Taiwan tensions. Tech is not doing well today. Let's flip the board. Take a look at some of the movers. Remember how yesterday I showed you was the Asia chip stocks getting the fuel from Nvidia, and then for the South Korean ones, it was how the government unveiled the package of support for the chip sector. Today, these are the biggest drags on the Asia stock gauge. Added concern for Samsung Electronics after a Reuters report that its high bandwidth memory chips failed an Nvidia test due to heat issues. And remember, high bandwidth memory is a market that Samsung has been trying to catch up to its rival SK Hynix in. So that's what we're watching in chip stocks. But flip the board again. I want to show you what we're getting out of Japan CPI numbers. We got it in line with expectations, and it was a cooling for a second straight month. But if you look at the core print at 2.2%, in line with expectations, still higher than the BOJ's 2% target. Indeed, this is the way it's been for the past 2 years, really making the case for the BOJ to accelerate that normalization of policy. Bloomberg Intelligence sees a rate hike in July, another one in October. Flip the board because that has implications for bonds in Japan. This week, we already saw the yield on the 10-year breaching that 1% level. It's hovering at the highest since at least 2012. Bond bears are really out. The higher yields in Japan not helping dollar-yen, though. We're seeing that level breaching that 157 level. It's really, really hard to fight the carry trade and the higher for longer narrative of the Fed. Tom.
Avril Hong in Singapore. Thank you very much indeed. Bring us the details around the Asia market moves today. Some really fascinating stories, particularly in the Czech semiconductor space, and of course the inflation story out of Japan as well. To the macro data in the US then, US PMI data for May in both services and manufacturing, surprising to the upside. The strong print has spurred bets on the Fed, holding rates until at least December. Let's bring in Garfield Reynolds from Bloomberg's M Live team then. Garfield, is this a market that is being reminded of the relative resilience of this US economy?
Well, I think we're being reminded of the relative resilience of the US economy and indeed of economies around most of the globe. We've had an understandable re-rating in the potential for rate cuts in the US, and in fact, at pricing about 1.5 cuts in now for 2024, that looks dangerously complacent. Just one you would think you would price in given the data, but of course the Fed had said it would do 3, so until they say otherwise, officially in the dots, it's hard to price in only 1 or less. And then when you look at UK CPI, you even look at the PMI in Europe overnight where, yes, inflation looked to be under control in that. That was mostly good news on the economy, good news on inflation, but it was still very good news on the economy. And economies around the globe just don't look like they're cracking seriously under the weight of the current elevated central bank rates. And that makes it less and less likely that we see a rapid move to easing, which has been the base case for investors for much of the last year.
Really, really interesting and important, as you say, to put this in the global context, not just a US story, in terms of the implications, of course, for those central banks globally. MLive's Garfield Reynolds, thank you very much indeed. To Italy now, where a 2-speed global economy is overshadowing this week's G7 finance ministers meeting. Officials are confronting the prospect of less synchronised monetary policy amid a resilient US economy and tepid growth, relatively tepid growth, though there are some green shoots coming through in Europe. Let's get more on this story then with Bloomberg's Oliver Crook, who is on the ground for us at the event in Italy. Good morning, Ollie. Can the G7 then tap in to these Russian assets to support the war efforts in Ukraine? This has been a debate that's been unfolding. The money is sitting there in some form. Are they going to be able to access that and come to an agreement?
Yeah, Tom, that's really the big project for the finance ministers here, is to really get that architecture in place in order for the G7 leaders to sign off on it in about 3 weeks' time. How do you monetize those assets that from the Russian central bank being held all across the world, but really mostly in Europe, and get them to Ukraine? And remember, the debate has been between the United States and Europe. The United States wants to seize the underlying assets. Europe says we're not comfortable with that. And so what they want to do is basically front load a large chunk of that money based on the future profits of those assets. Now, that may sound like a sort of good compromise, and on the top level there has been some agreement on that, but have a listen to the Italian finance minister speaking to us yesterday about some of the hiccups.
I have to be optimistic. It's not easy. The problem is how we are able to use the future window of profits to build a loan facility to Ukraine, but I am sure that we are able to make some progress, and perhaps for the next political summit in Apulia could achieve a solution.
And really, I was a little bit surprised by his tone, the tone of skepticism. This is the G7. This is a sort of an event and a group of people who should really be able to get consensus to move forward on this in what is a war of attrition, Yellen has called. And if there is not the sort of resilience and the will at the G7 to do it, then that will be a real problem for Ukraine. Now, the debate seems to be centering around what happens if, say, the war ends in about 5 years and you've committed the future profits of those Russian assets. Who is on the hook for that? That is going to be the discussion here between the United States and the G7 and all the other peers, and really in a critical moment for them to show some unity in the face of this aggression towards Ukraine by Russia.
Ollie, I know you've been thinking about this as well, and maybe it's a question of unity or lack of unity. The question of China, the question of how the G7 approaches China, particularly when it comes to the question of trade. How is that theme likely to filter through these meetings?
Yeah, Tom, it's a really interesting question. It's not technically on the agenda in terms of that China has not been mentioned by the sort of communiques, but it's something that Yellen yesterday, she said front and center, this is one of our priorities. We need, once again, the G7 to have a unified front against the sort of Chinese overcapacity, which is, the idea that they're producing a huge volume of all of this inventory and dumping it onto the market. Where it gets interesting, Tom, is the United States has thrown up trade barriers on EVs and a number of other things. The Europeans, we expect to get those tariffs in the next couple of weeks, the announcement there. But the interesting thing is when the United States moves on this stuff and moves quickly on tariffs, where does that overcapacity go? A lot of it comes right here into Europe. We saw that happen with the solar industry and happening elsewhere. So really, this is a forum for the G7 to discuss that and, again, to try to navigate what could be. And, again, this is a question I will be having for a lot of the ministers and central bankers here. Are we heading towards another trade war? And I think that looms large over this whole discussion here.
Yeah, particularly with the Chinese suggesting, at least threatening around the edges of their own retaliatory tariffs of around 25% on some European autos. Ollie Crook on the ground for us in Italy. A beautiful setting there at the G7. Ollie will be across all of this for us throughout the next few days. Ollie, thank you. Later in the show, we're going to go back live to Stresa in Italy and speak with Mathias Cormann, the Secretary General of the OECD, who's at that G7 finance meeting. That interview at 6:45 a.m. So stay tuned for that. Now, the US SEC has paved the way for the eventual launch of exchange-traded funds investing directly in Ether. It's the second biggest crypto asset, of course. Let's get more on this story then with Ryan Weeks, our senior crypto editor, standing by for us in Asia. Ryan, how significant is this move, paving the way, it seems, the SEC, to these potential spot Ether ETFs?
Yes, well, nothing has been approved yet, but there's now considerable optimism that spot Ether ETFs will be approved in the US soon. And that's an abrupt pivot from authorities in the US. As recently as last week, nobody was expecting these products to be approved. Why is it significant? Well, there's quite a big first mover advantage for the issuers of these products, the likes of BlackRock, Fidelity, VanEck. Let's not forget that the spot Bitcoin ETFs in the US have amassed $58 billion in assets since launching in January. And their popularity has coincided with a Bitcoin rally that saw it hit record highs in March. There's also potential policy implications here. So in the debate around whether or not Ether is considered a security. So the SEC has been quite ambiguous so far on whether it considers Ether to be a security, but the CFTC has said that it's a commodity. And some experts believe that an approval for spot Ether ETFs in the US would mean that the SEC had sided with the CFTC and now considers Ether to be a commodity. And that could spare developers and entrepreneurs in the Ethereum ecosystem a lot of cost around compliance.
OK, so that securities versus commodities debate or decision, at least how it's framed, is going to be really consequential, as you say. Talk to us about the differences regionally then between spot Ether ETFs in a jurisdiction like Hong Kong and those being proposed, the products at least, in the US.
Yeah, so a lot of the optimism around the approval of Ether ETFs in the US began on Monday this week, when some of the big issuers of these products removed plans to include staking in their proposed product plans. And that was seemingly to appease US regulators. What's happening in Hong Kong, where Ether ETFs are already live, is that issuers are now in discussions with local regulators about potentially adding staking services to the products that they already have out on the market. That's seen as a potential way to increase demand for these products, which in Hong Kong have had a fairly lukewarm reception so far.
OK, senior crypto editor in Asia, Ryan Weeks, on the significance of this step, at least a significant step, it seems, an important step by the SEC into what could be those total and final approvals of those spot Ether ETFs. Ryan, thank you very much indeed. Let's get you up to speed on what else we're looking at today then. 7 a.m. UK time. After that, consumer confidence came in for a second consecutive month higher. We're going to get UK retail sales. Retail sales at 7 a.m. UK time. So again, a gauge of the strength of the UK consumer. 1:30 p.m. UK time, we're going to get US durable goods orders. That after, of course, the composite PMI, the services and manufacturing data out of the US came in much stronger than many had expected yesterday. A jump, or the highest kind of in 2 years, in fact. And at 3 p.m. UK time, the University of Michigan Sentiment Survey is going to come through as well to kind of build out the picture in terms of the views on the US economy. Coming up, as South Africa gears up for a pivotal election, we're going to discuss investor sentiment and why it's turning a little bit more positive. That is next. We're also going to be coming up and discussing as well the AI-led stock rally with Marija Veitmane, the head of equity research at State Street. That interview at 6:30 UK time, how she's adjusting her portfolio in light of the gains around AI. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday, by the way. Let's get to the latest around South Africa then. A big, of course, year for elections globally. We've got them here in the UK, India, the US, of course, Europe, but also, very importantly, in the EM space, South Africa. Financial markets are brimming now with optimism as voters get ready to cast their ballots next week. Bloomberg's latest survey of EM investors found they believe the recent rally has room to run after the election. Let's bring in Bloomberg's Jennifer Tabasaja, who's on the ground for us in Joburg then. Jen, how are investors positioning themselves heading into this election?
Yeah, Tom, good morning to you. It really is a different story than what we've had been seeing actually leading up to May 29th. So right now, you mentioned that survey that we did here at Bloomberg. We're hearing a lot of investors more optimistic than they have been, and also saying that they're overweight or neutral on South African assets, and also more likely to invest here in South Africa than some of the other big powerhouses on the continent. I'm talking Kenya, Nigeria, and Egypt. And a lot of this is largely due to some new polling that is suggesting potentially the ruling ANC party. There's been all this talk about potentially the ANC is going to lose that majority, but now some polls suggesting if they do lose that majority, they still will be able to form a coalition with some of the more market-friendly, business-friendly parties, and potentially then that means policy continuity, and the government can focus then on some of the more structural reforms here in the economy. But yes, it's interesting now that many investors are now telling us potentially they see green shoots into the future. Definitely wasn't the story a few months ago.
Yeah, absolutely. It seems to be quite the about face, doesn't it, in this story? And on some levels, a little counterintuitive. But you're unpacking the rationale for it. What are the different combinations, political combinations, then, that would be most favourable, seen as most favourable, at least by investors and for the South African economy?
Yeah, so Tom, the real concern was potentially some of the more populist, more left-leaning parties would get more of a majority, and then the ruling ANC would then have to form some sort of coalition and potentially have to sort of concede to some demands from some of these parties. But potentially now the polling is looking like the ANC potentially forming a coalition with the Democratic Alliance, which is the main opposition party here, or even the IFP, which is again a more business-friendly, market-friendly party, and potentially then that means the ANC can continue with their policy continuity. And investors in this survey that we did here at Bloomberg are saying that a lot of these fiscal reforms that they have been seeing over the past few months gives them optimism, and potentially then that means we're going to see a lot of local assets overperforming. Of course, as we mentioned, we've seen the Rand, we've seen a lot of local stocks and bonds performing quite well. But the one caveat here, Tom, is that investors are saying, yes, these coalitions, these more favorable coalitions would be beneficial to the economy, but that is contingent on the government stepping in and instituting some new reforms just moving forward. So it will be short-lived, is what they told us, if there aren't some changes that are made, especially to the economy here.
OK, with that important caveat, Bloomberg's Jennifer Tabasaja in Johannesburg on the market reaction positioning around this important vote, of course, that kicks off next week. And Jen will be reporting from Cape Town, Durban and Johannesburg. She's going to be very busy next week. Don't miss that special coverage of the South African elections on Bloomberg TV, online and on the terminal. Coming up, is net zero by 2050 still possible? We're going to hear from the Bloomberg NEF team on the real cost of global climate goals. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, a new Bloomberg NEF report shows global climate goals are becoming harder to achieve the longer the world remains addicted to fossil fuels. BNEF says governments and companies will need to spend an extra $34 trillion on the clean energy transition between now and 2050 to reach net zero emissions. It's a staggering number, clearly. Let's bring in Mathias Kimmel now, head of energy economics at Bloomberg NEF, and so well positioned to talk us through this story. Mathias, considering these numbers then, I guess the key question is net zero by 2050 still within reach?
Yes, we think so, but it's going to be challenging. Last year, emissions increased yet again globally, but we think we may now reach a turning point. And this is to a large extent thanks to China, which is the largest emitter, but at the same time, it's also the biggest investor in renewables. In 2023, the country built almost 300 gigawatts worth of renewables, almost as much as the entire world combined the year prior. And also Europe and the United States are continuing to reduce their emissions. So if other countries join these countries in reducing emissions, we think it's still possible, but it's really challenging and we need to do a lot this decade to get on track.
Yeah, and you talk about the fact this is, of course, a critical decade. So before we get to 2050, we have to make some real progress by 2030. What specifically needs to be done and gotten done by governments and companies around the world by 2030 to get us on the right track then?
There are two main things. The first one is renewables. The second is electrification. Those are technologies that are available today. And in many cases, they're even cheaper than continuing to invest in fossil fuels. If you think about the power sector, we need to triple renewables built to 2030, and then we need another tripling to 2050. And in most cases, it's cheaper to do that than to build coal and gas plants. The same is true in the road sector, for example. We need to massively ramp up the production of electric vehicles, and by around 2034, we need to phase out the sales of gasoline and diesel cars. Think about buildings, heat pumps, etc., industry electrification. There's a lot of things we can do this decade, and in many cases, it makes sense so economically.
Yeah, absolutely. And a lot of those policies being debated at elections around the world this year. Talk to us about the cost then, the ticket price for this, an eye-watering, staggering 34 trillion or so. Mathias, talk to us about the implications of that cost, where that money could be coming from.
The 34 trillion are in addition to the base case, to the business as usual, let's say. So in comparison, that's quite a bit more. But in total, it's $215 trillion invested over the next 26 years. That's just under 5% of world GDP. That's a lot, but compared to what we need to do or what's the challenge ahead, we think it's really necessary. A lot of this goes into the power sector. We need more modern grids that can handle renewables. We need to invest in industry to be able to produce clean steel, for example. But we also need consumers to switch from petrol cars to electric vehicles. We need them to deploy heat pumps, etc. So there's a big task ahead as well for households and businesses to switch to clean energy.
OK, Mathias Kimmel, really fascinating, head of energy economics at Bloomberg NEF, on what needs to be done to get to those crucial goals around renewables and removing carbon from our ecosystem. If you'd like to hear more from BNEF's analysts, download the Switched On podcast on Apple. That's a Switched On podcast on Apple, Spotify, or wherever you get your podcasts. Coming up, we're going to get a view on how to position across equities, particularly around the AI space. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Asian stocks slip as strong US business data spurs bets on the Fed holding until at least December. A rocketing price tag for SpaceX. Bloomberg sources say Elon Musk's company is looking to sell existing shares, valuing SpaceX at roughly $200 billion. And we are live at the G7 finance ministers meeting in Italy, where Ukraine's allies are wrestling over a deal to use frozen Russian assets to support Kyiv. We're going to be speaking to the OECD Secretary General Matthias Cormann later this hour. Let's check on these markets then. Set for losses on global stocks and bonds this week. Yes, the optimism, the beat coming through from Nvidia, lifting that stock price yesterday, but not more broadly the US equity space, which ended in the red on concerns about stronger data coming through and further resilience for this US economy. European futures then looking at losses of 0.5%. The FTSE 100 pointing down by 71 points, off by 0.9% then, setting itself up for a fairly big hit, the FTSE 100 this Friday. The S&P futures are pointing to modest gains after the losses of yesterday, just by 0.1%, but they are back below that 5,300 level on the S&P. Nasdaq futures pointing to modest gains of 0.1%, currently flagged at 18,714. Let's flip the board and look cross-asset. In the Treasury space, you did see yields up on the back of that improving data picture around the US. And expectations now, the Fed may not be able to cut until possibly December. 492 then on the US 2-year, getting close to that 5% level. The pound at 126, closing in on 127. Of course, on the details around the UK consumer confidence picking up here in the UK for a second consecutive month. Of course, the politics is now firmly in focus as we count down to that July the 4th election as well. And Ether getting a lift up just 0.6%, but some important moves coming through from the SEC, the regulators over in the US, who could, it seems, get closer to approving spot Ether ETFs. And in Brent, $81 a barrel on Brent, currently just a little softer by 0.1%, but it's been a challenging week for the oil space. Prices lower on the back of an inventory build-up in the US. Now to that data then and the market reaction, the analysis. Buoyant US business activity and a tight labour market have sparked traders to push back the timing of Fed cuts until the end of this year. Not fully priced now by these markets until December. It was just November yesterday. Just one day and you've moved from November to December on the Fed and the first cut coming through in terms of the market expectations. Let's bring in then for the analysis Marija Veitmane, Head of Equity Research at State Street. Marija, good morning. Thank you for joining us. How difficult is it now to put a pin in the Fed and its first cut? How much confidence or lack of confidence do you have in terms of this question?
Yeah, good morning. Good morning, Tom. Good morning, everyone. I think that's a really good question. So when Fed can cut, it really depends on how strong US data is. And US data is very much, two tiers. So one day we get strong data, we get weak data. And I think that very much kind of reflects the very different experience many companies and consumers have from a tighter financial condition. If you are small, mid-size corporate, if you are lower income consumer, and actually now probably mid-income consumer, higher interest rates really squeeze you. If you are a large corporate with huge pile of cash on the balance sheet, or you are a wealthy consumer with lots of savings, higher interest rates are actually benefiting you. And that's what we're seeing right now in the economy. Part of the economy is doing well, part of the economy is doing poorly. So data is really we have this kind of data ping pong. One day it's stronger, one day it's weaker. And that's a real problem. A real problem.
I'm going to have to lift that line from you, Marija. Data ping pong is very apt, I think. And I like the way you frame this, a two-tier economic story evolving in the US. Where does that two-tier economic story then lead you in terms of your views, and this is your view, that ultimately you get an economic crash in the US? That's your take. How do you go from a two-tier economic story to a crash in the US, and what is the time frame that you've got around that?
Yeah, no, I think the way I'm thinking about the economy is that if it's difficult for central banks to cut policy, if we're having this higher for longer, the part of the economy that is under stress already, so they get even more stress. So if you're thinking about the kind of lower income consumer, so those people are kind of financing themselves via credit cards at 20+ % interest rate. So for them, delaying interest rate cuts is really painful. For smaller corporates who need to refinance their debt, again, delay of an interest cuts is really painful. So that's why every month we push it back, it's having real economic impact on those agents.
Are the markets underestimating the stimulatory and inflationary impacts of stepped-up AI spending, particularly around infrastructure, Marija?
AI, it's really fascinating topic, because I think up until actually maybe 6 months ago, maybe 3 months ago, we thought about AI as this like really exciting technology, lots of potential, and all we saw is kind of an equity market is multiple expansion. So that was kind of the big hope for it. Now we're beginning to see real economic impact. Now we're beginning to see companies making profits, be that, I mean, obviously semiconductor producers, absolutely, but we see software companies making money. We see, I mean, like you mentioned, energy company making money. So it's becoming a real economic power. So that's already becoming super interesting for equity analysts to dig in. So it's not just about multiples, it's about where profits are getting stronger and stronger. And to me, that's really underlying kind of the strength of the sim.
So where within the space, where within that stack, that AI stack, do you have a preference? Where are the outsized opportunities? Is it on the infrastructure play? Is it on the utilities and energy play? Is it targeting the models, the large language models and the companies behind those? Where are you focused?
I mean, for now, our general preference is large cap tech. That's the sector I loved for many years, and it's proven itself, kind of reinventing itself, finding new ways to make money. So I was incredibly happy to see like software companies already making money from AI ideas. So that's really, really interesting story for me. In terms of infrastructure, I mean, I do worry about utilities. Of course, they have this kind of huge boost in demand, but for extra electricity, but that requires a lot of investments, and that has not happened yet. I mean, in tech space, in software space, in hardware space, this investment has happened and companies reaping benefits. For electricity, we see huge demand requiring extra capex. Okay, that needs to happen, that next stage. Not yet.
Marija, talk to us about your preference, US versus Europe on a regional basis. Arguably, the green shoots of the economic recovery are coming through here in Europe. You've got a cut coming through in June, many would say. Certainly there's been little pushback from ECB officials on that. And some of the metrics on the earnings picture are starting to look a little bit more favourable. Why then prefer US over Europe, particularly with the valuation story?
Yeah, no, this is really important question. Lots of people do ask us about this preference. I mean, as we discussed, for us, kind of recession is coming. I mean, potentially. So if that's true, earnings are contracting, and you really, really, really want to stick with companies and regions where profitability can be a little bit better, where you can defend your profits, defend your margins, and that's definitely not Europe. It's US. Europe is really cyclical, so if recession is coming, it's problematic. Yes, it's true. Europe is improving, but from much, much lower base. So it's really level versus change. So European companies are a lot less profitable than US. That's reflected in valuations. And indeed, if we are going into recession, that it's not valuations that's going to matter. It's profitability, it's earning stability, it's earning quality. And that's US 100% over Europe.
OK, Marija Veitmane, thank you very much indeed for your take on these markets and how to position, Head of Equity Research at State Street. Now, switching focus, and Bloomberg sources say SpaceX has initiated discussions about selling existing shares at a price that could value the privately owned company at roughly $200 billion. For more, let's bring in Bloomberg anchor Kriti Gupta with the details. Kriti, walk us through the numbers then on SpaceX.
It is all about this valuation, $200 billion. It's not really chump change there, but it is a marked difference from the $180 billion valuation just 6 months ago. Now, look, Elon Musk, SpaceX, they do these tender offers every 6 months or so, as they're calling it, liquidity rounds for investors, for employees as well, because that's really how you get some of these shares of SpaceX to begin with. You have to be an employee. It's your easiest way in. But Elon Musk coming out and saying, look, this is not a capital raise at all. But what it does show is this is becoming a company that's getting only bigger and bigger, as shown by these liquidity rounds.
Well, they're just able to do things that other companies aren't able to do, quite frankly, aren't they? So we'll see how deep that moat is going forward. You talked about being an employee. Is that the easiest way? I have to sign up. I have to get a job at SpaceX in order to get some equity. How do you invest? I'm out the door. That's it. I'm signed out. Give me half an hour. How do you get a stake in a company like SpaceX? It's tightly held, clearly.
It's very tightly held. And look, and these tender offers, it's about $108 to $110 a piece when you look at the shares. So that's affordable for a lot of folks who are looking at buying just a single share. That being said, you have to be an accredited investor. You have to have earned income of over $200,000 for 2 consecutive years, or net worth of $1 million. So
that count me out then.
Yeah, already at the beginning, the standard is quite high. If you do even make that threshold, you still have to be vetted by the company. SpaceX can still say no. There's a whole background check involved. There's a lot going on. Or you can find an individual who already holds that and sell. You kind of do that on the private market. There was a joke on the terminal that you can do it via LinkedIn, put out your bids, find the individual investors and kind of beg them to sell their shares. Still, SpaceX can say no. It's that vetting process, and they're very careful about who they actually want. The easiest way to do it would be through a specialized vehicle, a fund, a space fund, a mutual fund that already has those shares. There's a couple that actively invest in companies like OpenAI, for example, or SpaceX. That would probably be the easiest way to go if you don't want to get a job at SpaceX.
I love that you've just mapped out the game plan for how to get some equity in SpaceX.
Some people want this exposure.
We need to talk to you about your 10% stake at some point. Kriti Gupta, thank you very much indeed. I jest, of course. Markets Today anchor on the story around SpaceX and that valuation, of course. Now, Elon Musk, talking of Elon Musk, wearing his Tesla CEO hat now. He's got multiple hats. Won't say if he's still committed to a low-cost EV. He was pressed on the issue during a tech conference in Paris, initially telling one reporter that it was difficult to answer such questions. Musk later said he didn't think the subject would be of interest to the audience. He also says he doesn't want either tariffs or tax incentives for EVs. And China has carried out its most expansive military drills in a year around Taiwan, ramping up pressure on Lai Ching-te just days after he took over as president. China's Xinhua news agency reporting that the drills were intended to punish, quote, separatist acts. Beijing has earlier sharply criticised Lai's inaugural address, saying he sent a dangerous signal of seeking independence. Coming up, we're going to speak with Mathias Cormann, the Secretary General of the OECD. That interview up next, live from Stresa, Italy, where G7 finance chiefs and central bankers are gathered for that annual meeting. We are live on the ground with that interview. Stay with us. This is Bloomberg.
The G7 has collectively recognized the need to protect our workers and businesses from unfair practices, and overcapacity threatens the viability of firms around the world, including in emerging markets. I believe it also poses a challenge to China's growth.
That, of course, was US Treasury Secretary Janet Yellen speaking at the G7 on unfair trade practices, alleged, of course, and challenges to China's growth. Bloomberg's Oliver Crook is also on the ground in Stresa, Italy, where the meeting, of course, is taking place. And Oliver, will be covering the story for us throughout the day. Ollie, standing by with a really special guest for us. Kick things off then.
Yeah, that's right, Tom. So as you say, we just heard Janet Yellen speaking. Really, one of her priorities coming here to Stresa and speaking within the G7 is really this priority of China and unfair trade practices, and something she really wants to build unity around within the group here. And so we're very pleased to be joined, sort of kicking off the coverage here, by Mathias Cormann. He's the Secretary General of the OECD and joins us now here in Stresa, beautiful Stresa, we should say. So listen, the big sort of overtone, a quiet sort of message that hangs over this is the potential of a sort of, are we walking towards a trade war? We've seen the Biden administration put up the EV tariffs. We're expecting the same from the European Union. How high do you rate that as a risk for the global economy right now?
Well, firstly, for the global economy, one of our objectives should be to reinvigorate global trade. And yes, I mean, there's a range of challenges. We need to ensure that we can have open markets, fair trade, free trade and fair trade, and we need to ensure that we can have resilient supply chains, that we address some of the social and environmental challenges associated with current policy settings. But what we should be doing is improving the way globalization is working and delivering for people, the way open markets and free trade is operating. But we've got to be very careful not to throw the baby out with the bathwater.
And how do you make that argument? Because certainly among populations, you also have a sort of a waning sort of belief in the globalization. And even within politicians who historically have been potentially more pro-globalization have sort of put up more protectionist barriers. How do you make that convincing argument?
Well, protectionism, fragmentation, decoupling will make us all poorer. There's no question. It will lead to lower growth, lower incomes, and it will drive up costs. I mean, consumers will pay more, businesses will earn less. And so we've just got to make sure that we calibrate any policy measures in this space carefully, that we, of course, ensure that we de-risk our supply chains, that we ensure that we can have resilient supply chains, but by the same token that we continue to benefit from all of the upside opportunities that open markets and free trade can help deliver to people all around the world.
And if we fail to do so, what do you think the implications are for growth and for inflation?
Well, in the end, as I've mentioned earlier, if we pursue if we enter into a new era of protectionism, if we pursue policies of fragmentation and decoupling, it will lead to lower global growth, it will lead to lower incomes around the world, and it will lead to higher costs for consumers and higher input costs for business all around the world.
And one of the places that the OECD really has a key function is really discussions around taxation. Particularly, we've talked about taxing the tech giants. Do you think that we're going to get a multilateral agreement next month? Do you think that you're optimistic for that?
Well, the first point is that the global minimum tax, the pillar 2 of that international tax reform agenda, is now a reality. By the end of next year, about 90% of in-scope businesses around the world will be subject to the global minimum tax. That is a very important step forward in terms of ensuring we can have a global level playing field for internationally operating businesses. When it comes to Pillar 1, the reallocation of taxing rights, we continue to work to a deadline of achieving agreement on the text and signing of the text for that multilateral convention by the end of June.
And one of the conversations that's also sort of been promoted here by some of the members and rejected by others is this question about a billionaire tax, a global billionaire tax. Do you think the OECD might be an appropriate place to have that discussion in terms of possible framework and push that conversation forward?
Look, at the moment we're focused on implementing and successfully landing the 2-pillar tax reform agreement that was reached some 2 years ago, and of course conversations in relation to the proposal by the Brazilian presidency in relation to this wealth tax, international wealth tax, are continuing, and we will continue to be part of that conversation.
And there's obviously geopolitical divergence. We've talked a bit about that, some economic divergence. We're also seeing rate divergence between the United States and many of the other parts in the world, which is having sort of large implications for a number of currencies and other factors. How do you rate that, sort of the kind of the risk to the market from that divergence between the Fed and others?
Well, the good news is that all around the world, across all major economies, inflation is heading down. Of course, I mean, there are divergences across the different economies, which mean that there will be different monetary policy responses. But overall, I mean, we think that overwhelmingly monetary policy settings will remain restrictive for some time, which doesn't mean that there won't be some adjustments down in some jurisdictions, but overwhelmingly we will see restrictive monetary policy all around the world for some time to come.
And another question is really about debt levels within the G7, but more broadly, and you have warned about the sort of the wall of maturities that is approaching. How do you rate the sort of risk of debt, and how do you see that actually playing out in the markets?
Well, I mean, that is one of the big risks over the next 2 or 3 years. Many of the debt issuance will have to be refinanced at higher rates, and the challenges here are obvious. And so what we've been warning of is that there is a real need to rebuild fiscal resilience and to have credible medium-term strategies in place to address the debt challenge.
And when you look at the sort of the lists of risks across the world, right, whether it's inflation, growth, geopolitical, what really worries you the most right now?
Well, look, I mean, the key risks that we're focusing on, obviously, there's a risk still that inflation proves to be more sticky than anticipated, but conversely, there's also the risk that monetary policy measures will overshoot and that we end up with having too hard an impact, and that is something that remains challenging to balance moving forward. But then the geopolitical risk is the very significant risk, because I mean it's sort of very hard to see how you can take effective action depending on where you are in the world, but you are on the receiving end of potentially very significant economic and social implications, of course. I mean, depending on what happens in the Middle East, we could see another supply shock. We could see another supply shock causing an inflationary increase, and so I mean there are of course things that are not immediately under the direct control of countries in other parts of the world.
And very hard to assess and price into the markets and elsewhere. Mathias Cormann, who is the Secretary General of the OECD, there kicking off our coverage here in Stresa, Italy, for the G7 finance ministers, central bankers, talking about globalization. Can we reinvigorate that conversation and really put forward the benefits, which is really what their priority is, so lower prices and higher growth for a global economy?
Great stuff, Ollie. Ollie Crook, of course, on the ground for us in Italy, there with the OECD Secretary General at that G7 meeting in Italy. There are going to be plenty more interviews that Ollie Crook will be bringing to us from that G7 today, including Paolo Gentiloni, by the way, the European Economy Commissioner. That will be an interesting one. Plus, and this will be crucial, an exclusive conversation with Joachim Nagel, the Bundesbank president and ECB governing council member. Really fascinating as we expect that cut from the ECB in June. Stay with us. This is Bloomberg. Welcome back. Happy Friday. Here's the good news is bad news for the markets theme. Back with us, and we focus on the PMI, the composite data that came out, manufacturing and services out of the US yesterday for the month of May. And hey, on one line, this is good story, right? This is reminding us of the resilience, the strength of that US economy. Here's the line. The white line is composite, and you can see that edging higher. But within that, it's services that is really showing the strength. Yes, manufacturing got a pick up as well. But this is the biggest jump for composite that we've seen in about 2 years. The yellow line is services. Really important as well, I think. Input prices and prices charged both edging up. You're at 54.4 on composite, well in to expansionary territory. Above that 50 line, of course, raising questions, reinforcing really the view that we got from those Fed minutes that they do need to be higher for longer, because it's going to take that much more time to get to that 2% target, given some of the strength that's coming through on some of these economic data points, at least out of the US. Let's flip the board, and I think there's a really relevant question as to whether or not the spending around AI and Nvidia is going to be stimulative and add more inflationary pressure for this US economy. And here's some size and scope around the size of this company now in terms of market cap. 2.5 trillion. It rallied 9% yesterday. It's up 110% year to date. It's up 170% over the last 12 months. 2.5 trillion. You've got Microsoft, you've got Apple, and then you've got Nvidia in terms of market cap. But this now, in terms of market cap, is bigger than the entire stock exchanges of Australia, South Korea, and yes, Germany. Let's flip the board and see what this means for the wealth then of Jensen Huang, who of course founded this company in 1993. 91 billion US dollars. He's 17th on the Bloomberg $1 billion index. He's got more wealth then than individual members of the Walton family. He has a 3.5% stake in this company, and he's sitting pretty right now. There's a lot more coming up. Markets today. Stay with us. This is Bloomberg.